Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger, and it is Thursday at 11 a.m. Eastern Time, and that means it's the live stream. An opportunity for you guys to ask me, pretty much whatever you want, mainly about money, I think, investing, retirement, credit cards, credit card rewards, debt, mortgages. I'm actually in the process of helping our daughter buy a home, so I've been knee deep in things like mortgages and all that sort of thing. Happy to answer any questions about that process. So as folks join the chat, give me a shout out as you're watching the live stream. Let me know you're here. I don't know, your name, where you're from. That'd be great. And we will get started. I'm gonna keep the sort of the intro part of this live stream fairly short. We're gonna do just a 5-question true and false investing quiz. It couldn't be any easier, right? I mean, how easy is that? True or false? You at least got a 50-50 shot, right, at getting each one of these. I've kind of picked Salty, you're back, man. I was hoping you'd come back so that I could tell you that I absolutely bombed in the chess tournament last weekend. I mean, it was a disaster. I'm embarrassed at how I played. I played well below my playing strength. Some of the moves, I just don't even know what I was thinking. It was that bad. Hey Roger, glad to have you. San Francisco, so you're at least on the early side of the day. Welcome. So we're gonna do this quiz, and I don't know, maybe I'll start doing a quiz every week if you guys like it. I've come up with the questions. Some deal specifically with investing, some deal with retirement accounts. Who knows what I'll do in the future, but I kind of picked them in a way to spark at least a little discussion. So we'll see how that goes. Welcome, James, from Leesburg, not far at all. I'm trying to work towards biking from Vienna, I guess, to Purcellville. I got a road bike, and I live right off of the WNOND trail. It's a 45-mile trail. I've been to the other end, which is by Washington, D.C. and Reagan National Airport. It goes out to Purcellville. I've gotten to Ashburn. That's as far as I've gotten. Hey, Paul, welcome. Someone from Columbus, Ohio, hang on. And it's Sridhar, and I'm sorry if I mispronounced that, but OH. Always keep this close in case there are any Penn State fans around. Double Dog Blitz wants to know what time you go live. Well, it was 10 a.m. And then, you'd think since I'm more or less retired, I could do this anytime I want, but it turns out life is not that simple. So it's currently at 11 a.m. Eastern Time. So the live stream has just started. And so that's the deal. Paul from Florida, welcome. And Salty, if you mean oh do tell, in reference to chess games, I mean, it was a disaster. I ended up with 1.5 points out of 5, which means I drew one game, I won one game, I lost 3 games. And I mean, I lost games that had an overwhelming advantage and would just blunder. Anyway. All right, Tony, IO, love it. So I want to go ahead and get started. And I know a lot of folks watch and don't participate in the chat, and that's cool, that's okay. But I think as we get going, we'll get more folks in. And for those that have shown up at 11, I want to get going. So we're going to start with the quiz. Here's the first question. You can leave your answers in the chat. Here we go. And by the way, Felix, welcome from Kenya. Number 1, non-dividend paying stocks don't benefit from compounding because there's nothing for us to reinvest. Right? We don't get a dividend that we can reinvest back into the company. So they don't benefit from compounding. True or false? And by the way, we've got 2 Jims from Leesburg. What are the odds of that? Ari says hello. Hey, man. Aiden from Maryland, close by. Tony says, no worries, we all can't be Magnus Carlsen. Yeah, I'm definitely not threatening his dominance in the game, that's for sure. So we got our first actual answer to the question, and that is from Jonathan. He says false. Lots of falses, some true, one true. Lots of falses. By the way, feel free to indicate why if you want, but this is the tricky thing about understanding dividends. The answer, So I'm going to give you my answer. I'm fairly confident of it. That doesn't mean I'm right, and it doesn't mean you have to agree with me. It reminds me of the theme song to Monk. I could be wrong now, but I don't think so. It's a jungle out there. Anyway, so my answer is false. Non-dividend paying stocks absolutely benefit from compounding. And the way they do it is, a company, take Berkshire Hathaway, never paid a dividend, but it makes a ton of cash. Now, what does it do with it? Well, it doesn't pay a dividend. It reinvests that money back into the business. That's where the compounding comes from. It's no different than if you owned, I don't know, a dry cleaner. And, you made $1 million 1 year. You didn't pay yourself any money. You didn't pay a dividend. You poured it back into the business. You opened up new locations. You modernized your equipment, whatever. And that helped you grow even more. So if you do receive a dividend or any kind of income from an investment and you want that to compound, you do have to reinvest it. Obviously, if you go spend it on Slurpees at 7-Eleven, and I'm not sure why I use that as an example, it's not going to compound. So if you do get a dividend and you want it to compound, you have to reinvest. It doesn't have to be reinvested in the same thing that generated the dividend. I could get a dividend from Apple and reinvest it in Microsoft. How well I'll compound depends on how well the investments are that I put it back into. But that's my take on it. Now, the second question is related, so I'm going to show you that now, and then I'm going to get back to the chat and see who else has joined. Number 2, if non-dividend paying stocks benefit from compounding, so must assets like gold and Bitcoin. They don't pay a dividend, but so what? We've already established we don't need a dividend for compounding, so gold and Bitcoin must compound as well. True or false? Double Dog Blitz is from Tim from Minnesota. I don't know, Tim. I kind of like Double Dog Blitz as your name, but we'll go with Tim. Let's see. Jonathan hit the nail on the head on number 1. The money that doesn't get paid out as a dividend gets reinvested in the company. Absolutely. Nathan, hello. Thanks for joining. Salty says, trick question. Was that a trick question? Oh, I don't know. Jonathan from the Northeast Arkansas. So on question 2, so far we've got a lot of falses. We got one true. So this is an interesting question. I've pointed out that in the past that, let's take gold, for example. It doesn't do anything. It doesn't generate any cash flow. And some people have corrected me and said, no, you're wrong, Rob, because if you have like a gold ETF, you could sell covered call, for example, and generate income. My response to that is, gold is still not generating any income. You may sell a covered call on a gold ETF, for example, but a covered call is a totally different investment than gold. I understand you've connected them in a way, but they're two totally separate investments. So gold and Bitcoin don't compound. They just, if you had an ounce of gold 20 years ago and you held on to it, what do you have today? You have an ounce of gold. Now, the price may go up. The price may go down. Depends on your time period. Same thing with Bitcoin, right? Well, I doubt you owned Bitcoin 20 years ago, but you get the idea. But 1 ounce of gold is always going to be 1 ounce of gold. We can compare that, by the way. Let me bounce over to, I was looking up Apple, which I own shares of Apple. This is Apple's balance sheet from 1994. And it's kind of funny. The dollars are in thousands. They don't do that anymore. Their dollars are in millions now. And if you look at something like just their assets, total assets, 5 billion, right here, 5.3 billion. Shareholders' equity was 2.3. If we look at it today, and that's their shareholders' equity, which I was looking at before I started the live stream. So these numbers are in millions, which means, by the way, you would effectively add 6 zeros to all of these numbers. Their total assets have grown by just a tad, right? $323 billion. Shareholders' equity is $65 billion. And that number is actually even more amazing when you understand, like if you look at the previous year, it was 90. And say, wait a minute, what happened here? Shareholders' equity went from 90 billion to 65. What the heck happened? Well, that's where you go down to shareholders' equity, and you can see their growth is phenomenal, even though, look at this line here, are the dividends they're paying out each year, 13 to 14 billion with a B. And that pales in comparison to the share buybacks. Look at these numbers. And these come right off of retained earnings, 73 billion, 67 billion, 72 billion. So, and now of course, Apple now pays a dividend. It didn't always. In fact, it started paying a dividend, I want to say about 10 years ago. But it has, of course, generated tremendous compounding of returns. But the point is, if you owned, X percent or X fraction of a percent of Apple during this same period that we just looked at, what you own today is very, very different than what you owned, 30, 25 years ago. If you also bought an ounce of gold back then and held it, what would you have today? You'd just have an ounce of gold. So my view is, no, these things don't compound. So there you go. That's my take on it. All right, number 3. As the leader of passive investing, Vanguard offers the lowest cost index funds. True or false? Any answers to that? I mean, that's an easy one, right? Lisa wants me to define compounding. It's a fair question. What are compound returns? It's when you earn returns off of returns. That's how I view compounding. You invest $100, it earns $2, and then you start to earn money off that $2 in addition to the 100. So returns on returns would kind of be how I think. That would be my, let me see if I can get fancy here with my stream. We'll go over here. So you can see my ugly mug. That would be my sort of simple definition of compounding. I'm not sure how well that would technically, satisfy, I don't know, professor. So you guys nailed this one. Yeah, it turns out Vanguard isn't the cheapest. I mean, Fidelity is cheaper. There may be others. I don't know. And I'm not even talking about Fidelity's zero funds. I did a video on the zero funds about a week ago. But just their straight up S&P 500 index, total market, international, whatever. They pretty much are cheaper than Vanguard. So I don't know, Vanguard. What's the deal there? Anyway, now I will say they're only cheaper by a couple of basis points. But I honestly was surprised. I just, for a long time as a Vanguard fan, I just kind of assumed they were the cheapest. And they ain't. All right. Number 4, we're going to turn to retirement. All tax-advantaged accounts allow you to take out money for any reason, penalty-free, once you turn 59 and a half years of age. True or false? And if you say it's false, why? Which kind of maybe gives it away a little bit. This is a trick question. We've got some falses. Some aren't sure why, though. Yeah, it kind of just smacks as a trick question, right? Doesn't it? I get that. Some are saying true. I'll give you a hint. I didn't say, the question is not all retirement-based tax advantage accounts. Does that give a hint? There's one account that doesn't follow this rule. And actually, I suppose you could even put in like 529s, which followed totally different rules, but even excluding that, even excluding 529s for a moment, which is a tax-advantaged account. Anyone use HSAs? Health savings accounts, if you have a high deductible plan. Of course, you can take money out anytime you want, tax-free if it's for a qualified medical expense, right? But what if you want to take it out for some other reasons? And some people, like myself, use HSAs as sort of a retirement savings vehicle. To avoid the penalty, you got to be 65. Yeah, it's different. It's good to know, though, right? And by the way, there could be, whenever you try to use common sense to navigate taxes, at least in my experience, that's when I know I'm heading for trouble. That's when I'm going to make a big, big mistake. Like, for example, we donate to charity, and we do it through a donor-advised fund. And we fund that donor-advised fund, we have ours at Vanguard, through appreciated stock. And so, particularly now that we have we have SALT limitations, which may or may not go away, we tend to fund the donor-advised account every other year. And one thing that's nice about it is, even though we fund it every other year, we can actually give to the charities we care about. In our case, most of the charities help children, anytime we want, once it's in the donor-advised fund. But Here's the thing. I always just assumed whatever I put in there, I could deduct that year, but it turns out there are limitations. When you're giving appreciated stock, I think it's 30% of adjusted gross income. I think that is the number that limits you. Now, if you get limited and you can't deduct it all, you can carry it over. But, I just make all these sort of assumptions about taxes, and I turned out to be really wrong. All right, number 5. A fee-only advisor who is a fiduciary must act in your best interest, including charging low fees. And by the way, Vinyl 1, whoops, I just added a blank page. Hang on, here we go. Vinyl 1 Earthlink, always read the IRS publication carefully. Couldn't agree more. Actually, the IRS has got tremendous resources. But still, one of the problems is, you could get something right in one part of your tax planning, but not realize that it affects something that seems completely unrelated. You got to really be careful. Jonathan says he just recommended an HSA to a friend this morning. Mr. Wrestling, buy $50,000 worth of aspirin. I'm not even sure. That seems like a lot of aspirin. The answer to number 3. The answer is false. Fidelity has cheaper index funds. All right. For this one, we've got a lot of falses. Yeah, so here's the deal. When they say fiduciaries, and fee-only advisors are typically fiduciaries, and they'll tell you, when they say fee-only, what they mean is, we're not getting paid by the investment products that we're recommending. For a lot of advisors, it's just the opposite. They sell you some form of insurance. They get paid by the insurance company. Non-traded REIT, they get paid by the REIT. Mutual funds. If you follow sort of Dave Ramsey and his approach to investing, and you use American funds, which, by the way, some of the American funds have done really well, but your advisor is getting paid from them, part of the load that you pay when you buy. And then they also get paid a little bit out of the expense ratio, I believe. With fee-only advisors, their selling point is, look, we don't have a conflict of interest because we're only getting paid by you, the client. So we're not getting paid by Vanguard's index fund or such and such a firm's actively managed fund, and we have to act in your best interest. However, there's nothing that prevents them from charging 1%, which is an absolute outrageous fee, let alone 1.5 or 2. I looked up, Rick Edelman. Look up his fees. Anyway, and he could be brilliant. I don't know. His firm could be wonderful, but the last time I looked them up, they were expensive. Of course, I view 1% as expensive. So there you go. That's the quiz. What'd you guys think? Anyway, I hope you liked it. If you did, maybe I'll do some more. All right, so now it's your turn. Actually, there is one thing I want to mention before I turn to your questions, if I can find it quickly. It was an interesting email. Let me see if I can find it. Oh, here it is. Let me read you this email I got, and then I'm going to turn it over to you guys. Then we'll talk about whatever you guys want to talk about. So get your questions or topics ready. This came from someone named Ronald, and the email, the title was Dry Powder. He says, I recently came across your channel and in one weekend viewed about half your videos. Man, that's a long weekend. Anyway, I find you balanced, thoughtful, and insightful. Well, thank you. Let me get down to his question. Historically, he also said he ordered my book from Amazon. Thank you. That's I hope that you liked it. Historically, I have done well at putting away a significant amount of my income into different retirement savings. In the past, I've kept my investments in the same funds unchanged, but have been significantly burned in both 2001 and 2008, taking 4 to 7 years to get back to my original principal. Many of my friends have done significantly better by paying attention to, and he puts this in quote, market conditions, and adjusting their portfolios to other assets like U.S. Treasuries and money market funds and commodities, gold and silver. I saw you recommending somewhat the same. Not sure what. Maybe that was my showing some data that suggests gold, could help in the long term reduce volatility in a portfolio without significantly reducing the returns. I think that's what he might be meaning. Some of my friends follow the lead of individuals such as David Hunter, who I've never heard of, and Warren Buffett. I've heard of him. Fear when others are greedy, and greedy when others are fearful. Interestingly, many hedge funds are in cash, as is Berkshire Hathaway's fund, stock, I think, with over 133 billion in cash for use as what they call dry powder, to make acquisitions at the bottom of the trough. I guess they are trying to time the market. As for myself, I am also out. Yes, I will not get that last. So I think what he means is he's out of the market, I think. I will not get that last 4 to 8% gain, which might occur, but at the very least, I will not have the loss that took so many years to regain in the past. I too will have some dry powder to acquire assets when I feel more comfortable. According to many analysts like David Hunter, this retracement might be as much as 70 to 80%. The stock market could fall 70 to 80%. Having said that, here's this question. What strategy would you have for individuals who will have dry powder when the market does retrace? Okay. It's a great question. I mean, we're all thinking about it. I mean, how can you not think about the stock market, the bond market, our country's debt? I mean, I get it. So here's how I think about that. First of all, I think I would ask Ronald some questions. I don't know if he's in the live stream. Anyway, I would say, first of all, it took you X number of years to regain after losses, sure, and that's true for all of us. But it sounds like it did. I mean, it sounds to me when I read his email like he's a living example of the success of buy and hold investing. Now, he's since taken his money out apparently, so let's put that aside for a moment. But at least until he did that, he'd stuck to his guns and by all accounts did exceptionally well. I mean, it kind of broke my heart. I gotta be honest. Is that too emotional? It's like you did it. You lived through 2 horrible markets. You survived them. You did kind of what I did, and you came out at the end of it. And sure, it took a few years, but look where you ended up. And now he's changed it. The problem is, and he says he has friends that did much better. When friends tell me that, and I do have some that kind of take that approach, I want to, okay, tell me exactly. When did you sell? I want the date. And when did you buy in? Give me the exact date. And I never get a solid answer. It's always sort of wishy-washy. Well, I kind of sold a little over here, and then I did this, and I'm like, do you really know how you did compared to just buying and holding? It's like my friends who are options traders. I said, do you have any idea what your wealth today would be if you never sold your covered calls and you just held the assets? They have no idea. They don't know. So, but having said that, and I looked up David Hunter. I don't know much about him. He is kind of the view that he can predict the markets. I read a Forbes article that said in April of 2020, he predicted that the S&P 500 would hit 4,000 in September of last year. That proved to be wrong. It has since hit 4,000. In fact, we can look at it. Let's see here. It's at 4,500. I think it hit 4,000 in April, but he was wrong. That's fine. I don't even mean that as really a criticism, other than, of course, his prediction is going to be wrong. All of mine have been wrong. I mean, people just don't predict things that accurately, and if they do, it's a one-off. Then he predicted, I think for last fall, that we would have a crash that would, rival 1929. Well, that was false too. That didn't happen, right? And so I don't know if he shorted the market. If he did, he lost a lot of money. I don't know. I don't know. But I do know this, that Warren Buffett is not timing the market. There's a big difference between timing the market and buying things that are undervalued. Right now, if you think about value, if you're going to come up with a value for Apple or Microsoft or any company, it's not going to be a number, right? It's going to be a range. No one's good enough, even Warren Buffett himself, it's going to be a range. And if you're not as good as Warren Buffett, like myself, right, my range is going to be much bigger. He'll be able to come up with a much smaller range of valuation for an asset, a company, than I will, because he's smarter, a lot more experience. It's his business, right? So his range could be here. My range might look like this. That's fine. Given the market, it's hard to find things, particularly when you're dealing with ranges as large as mine are. When I try to value something, that is selling, below that, right? But what Warren Buffett is doing is waiting until he can buy something that is selling at a minimum comfortably within his range of value, and preferably something, a price even below that. And so he's just patient. He may wait years. He's already waited years. He buys a few things here and there, as Berkshire does, but he's going to wait. It's not about market timing. So he and David Hunter, from what I can tell, are two totally different investors. I've never heard Warren Buffett say, the S&P 500 by the end of the year will be at X. He just doesn't think that way, or at least not publicly. So I think if you're sort of the index fund buy and hold person, I just leave it alone. I haven't sold any of my index funds because the market is up here or whatever. And if you're dollar cost averaging, you're contributing, I continue to do it through good markets and bad, because my ability to time the market is just, I can't do it. If you're a stock picker, and I do have 20% of our portfolio, in my case, it's in four stocks: Apple, Berkshire, Bank of America, and Wells Fargo. Wells Fargo's been down the last couple of days. I think it's up today. I do look at valuation, or I tried to, it's not about timing the market. It's not about, like, take Wells Fargo. It dropped 5 to 10% over the last 2 days. It's pretty ugly. I can show you again. Let's look it up here. It's right here. We'll look at it for the week. Here's my investment for the week. All that red. It was up close to 50, and then it went down to 40s. One could say, well, there's your dry powder, Rob. It went down, buy it. Well, yeah. There's another way to look at those numbers, though. We could go to 6 months. If I think it's a great buy here, why wasn't I buying it back here just a couple of months ago when it was actually lower? And in my case, there's a lot of different reasons. One is I've got enough allocated to banks. So I don't want to put more to banks. At least I don't think so, not right now. And I bought it cheaper than that. I bought it in the 30s. And so, if it went back to the 30s, I might buy more. But I'm thinking valuation. When I bought it in the 30s, I had no opinion about how the stock would perform this year. None at all. I had no idea if it'd go up or down. In fact, I think it went down a little bit after I first bought it, because I bought it like right around here, 33 maybe, and it went down to 29, almost right away, almost as soon as I hit the buy button. Anyway, so I think it's an important email that he sent me. I just don't think that way. For index funds, I leave them alone. For stocks, I buy when I think it's cheap. The only exception is credit card rewards. it's a small amount of money, but I just dollar cost average that into M1 Finance every month with whatever credit card rewards I earn, but that's a few $100. With stocks, I wait until they're on sale. And for me, they have to be on they have to really go on sale, as I said, because my ability to accurately estimate the intrinsic value of a company is not as refined as someone like Warren Buffett. All right, there you go. Enough chit chat. Let me back up in the chat and see what we got going on. What do we got here? Here's one from John. He says, what are your thoughts on diversifying your equity portion of your portfolio among the 11 sectors, because the market is so heavily weighted in information technology? So, of course, you do that, right? With an S&P 500, it covers all 11 sectors. But I guess, John, your question is, and I actually touched on this in the Rate My Portfolio video yesterday, right? And maybe that's where the question's coming from, because Belinda, who sent in the portfolio, her advisor had her in a sector fund you think of it like the S&P 500, but they decide how much to put in each sector. And there are sector ETFs. So rather than investing in the S&P 500, you can invest in the 11 sector ETFs and then decide for yourself how much to put in each one. Well, number one, it's a lot of work. Not only do you have to set it up that way, but then you got to monitor it and decide, when are you going to make changes and what's your methodology and all of that. And again, I don't think I'm really good at valuing a whole sector. I mean, we can all look at, say, technology and say, boy, that seems overvalued, and it will, it's got to come back down at some point. Assume it will, but I'm not good at the timing. In fact, if I were going to do that, I'd have probably been out of technology a couple of years ago. So, John, in your case, you may be better at it than I am. I just, to me, I find it hard to believe that I will outperform just an S&P 500 by trying to weight the sectors based on my own sort of evaluation of their current, worth. So that's my take on it. A different Jonathan says, Fidelity was the HSA that I recommended. I think that may have been in response to someone else, but I will say Fidelity has an excellent HSA. And so the deal on HSA, when you're employed, you don't actually have to use your employer's HSA, but it's usually recommended for two reasons. You tend to get some contribution from your employer, and you have to use, at least in my experience, maybe there are exceptions, you have to use their HSA to get it. But the second reason is, if you can make your contributions outside of your employer, outside of your paycheck, it is a deduction on your federal taxes, but not if you do it through your employer and through your paycheck, you also don't have to pay the payroll taxes on those contributions. So to me, and I'll add, most of the HSAs I have through employers have not been the best. What's it mean to be the best? Well, low fees, right? Good investment options. But the other thing is, and this is where Fidelity shines, and there's some other ones to do this too, is you can invest from the first dollar. Some of these HSAs require you to hold $1,000 or $2,000 or $3,000 in cash. Well, that's fine if you plan to spend it each year on medical expenses, and if that's your plan, that's great. That's what it's for. But if you're like me and you just are going to hold on to it for a while, I'd rather not have that money sitting in cash. So Fidelity sort of ticks all those boxes, and I think they're great. All right. Lisa says, I want a flat fee advisor. They're hard to find. They are hard to find. You can find them. I've mentioned Mark Zorel of Plan Vision, and I have no financial relationship with him. I think he's good. Rick Ferry at one point did this on a flat fee basis. I mentioned him. A friend of mine wrote all about asset allocation. I don't know if he still does. They are hard to find, but you can find them. At one point I wanted to put together a resource that listed all of the flat fee advisors. So do me a favor, if you know of any, shoot them over to me. You can just go to robberger.com. There's a link for my contact page at the bottom. Give me their name, their website. If you're an advisor watching this and you offer flat fee, let me know. I'd love to put together a long list for everyone. All right. What else we got here? All right, Trevor. Hey, Rob, I have a question I think a lot of us might have. When adding a taxable account to your long-term goals like retirement, do I invest in index funds or bonds in that taxable account? That's a great question. Although I get distracted by Angered N who says, go blue. That should not be allowed on this channel. Anyway, so a couple of things I've learned. In theory, what they say is bonds should go in tax-advantaged accounts. Why? They generate interest, and that interest is taxed at its ordinary income. And that's fair enough.
I found some websites.
Jeez.
I'll send them to Rob's iPhone.
My Siri just started talking. It scared the crap out of me. Okay, I'm back. I don't even know what I was saying. So, Bob, I'm going to have to unplug that for next week's live stream. So that's the theory, and it's not a bad one. The only thing I'll say right now is bonds are paying so little in interest. I'm not sure, how significant the tax hit would be. I like to keep investments that I think are going to grow the most, like a small cap fund or certainly equities generally in Roth accounts, right? Because I want to get those as big as possible. The one thing I learned this the hard way. Index funds generally are very tax efficient. The Vanguard funds are very tax efficient. But remember, you get long-term capital gain treatment on qualified dividends. And you can Google what a qualified dividend is. There's a number of things that it has to satisfy. But here's the one thing that I would caution. If you're gonna invest in an international fund in a taxable account, take a look at their distributions and how much of their dividends are qualified, because one of the requirements is that they're, and I'm not going to get this exactly right, but they're basically, it's not U.S. companies, but let me see if I can look up a list. The point is, international index funds can generate non-qualified dividends, something that I've sort of learned the hard way. And so I get, a chunk of money. Here it is. So here, I'll just show you this on the screen. This is just from Investopedia, so I don't know if it's right, but they're usually pretty good. The dividend must have been paid by a U.S. company or a qualifying foreign company. This is number one right here. That's what I'm talking about. So I have an international fund. It's Vanguard fund in my taxable account. I didn't even think about this when I put it there. And now it's got all these gains, so I'm not going to sell it. But I pay more than I care to admit in basically ordinary income from dividends from that fund. So keep that in mind. So index funds generally, with all those caveats, I think are perfect for a taxable account. I think some bonds or cash in a taxable account are okay. You just got to keep in mind that the interest on them, is going to be ordinary income. You may be in a tax-free state and your tax bracket might be low. There are all these other factors that you want to consider. I think generally from an asset location perspective, which is what this is called, where do you keep your various assets? Normally, they say bonds go in like a tax-advantaged account. Okay. Roger is looking for an alternative to certificates of deposit that pay higher level of interest. Any ideas? Well, today you can do better or as good with just a savings account. I-bonds at the moment paying a really good rate. Of course, there's all kinds of limits and restrictions on when you can sell. I think Axos Bank is probably one I think it's 61 basis points, their savings account. I mean, it's nothing to get excited about, but it's, I guess, not terrible. I'm just looking it up now to see if they're still at 61 basis points for their savings account. You can find other accounts that pay more, but there are all kinds of limitations, $10,000 limit, or, it's a checking account and you've got to use their debit card so many times, or, whatever. So, but there are other things that pay more, but again, you got to jump through a lot of hoops. So, but I think Axos Bank is one of, there could be like community banks and credit unions that might have some special deals, but in terms of sort of nationwide banks, I know Axos, AXOS, they actually have a rewards checking where you can earn up to 1%, but I think there's, again, all kinds of things, hoops you have to jump through. I'll show you what I'm looking at. And for some reason, I don't know if it's my internet or the banks, but it's really slow. So we'll see I'll go to the next question while that loads. We'll see what happens. I'll put my ugly mug back on the screen. All right. By the way, Roger, that's probably not a very satisfying answer, but it's the best I got, man. That's just not good. Yeah, they're still at 61 bips right there. There could be better ones out there. A great site, I have allcards.com. And I keep some information on there, but truthfully, the better site, I'm downplaying my own website, is depositaccounts.com. They have just about every bank listed there. All right. Okay, Double Dog Blitz wants to know, which I think is Tim from Minnesota, if I remember correctly. But anyway, VGSTX, is this a good active managed fund from Vanguard? It's in a Roth. Well, let's find out. VGTSX, here we go. So that's not an actively managed fund. So I don't know if you've got the ticker wrong or whatever. That's their total international stock index fund. And I think it's a perfectly good fund. I mean, some would say you don't need any international exposure. That's a whole big issue, and I'm working on a video on it. That didn't look very good. Let's see. We'll go to Morningstar. Whoops, where'd it go? Here we go. But yeah, that's an index fund. And I think I either own or have owned shares of it. If I don't own shares of it, you think I would know off the top of my head, right? But I think I switched because of tax loss harvesting during the COVID drop. And I think I switched out of this to a different Vanguard International Fund. Roger wants to know, book, question mark. Yeah, I published Retire Before Mom and Dad. That's the name of the book. I'm working on slowly. I've got several that I want to write. The Retire Before Mom and Dad was aimed at 20-year-olds. I was hoping my kids would read it. I'm still hoping. Okay. So Vinyl One Earthlink says the typical alternatives, I think, to CDs are preferred stocks and REITs. See, I don't view those as alternatives. To me, they're just totally different investments. They may be perfectly fine, but they're just totally different because their risk profiles are totally different than a certificate of deposit that's FDIC insured. That's my view. It's kind of like people that say, bonds or yields are low, so let's buy utility stocks. Well, that may or may not be a perfectly fine thing to do, but comparing the two, they're just not comparable. You can lose a lot in a utility stock, or they're volatile. I mean, maybe not like, I don't know, Tesla, but all right. This is from RA. Who would be best to consult with if only want advice, not management for taxes, leaving money to kids and grandkids? Well, for that kind of thing, either a tax accountant, or if the focus is leaving money to the kids and grandkids, I would go to a trust and estates lawyer. And we have one. I mean, I'm a lawyer. Well, I've retired now, but I don't know how to write a will. That's not what I did. I didn't do anything useful. It's amazing how many times I had to tell friends and family, oh, you need help with that? Yeah, I don't know a thing about anything that you would probably find useful. Let's see. Yeah, I think I answered your question, RA. I mean, for taxes, you go to a CPA. But for leaving money to kids and grandkids, I would want a trust and estates lawyer. James says or asks, I'm a retired federal employee. I'm 62 and thinking next year about starting to withdraw on my retirement accounts. Do you have a withdrawal strategy? I only want to sell high, LOL. And that's all of us. We only want to sell high. By the way, what's high? That's the question. I guess now is high, I think. One thing I'll say that's been on my mind lately, people will look at the PE of the market, and we could look at it. I'll pull it up. We can just go to S&P 500 PE, and they look at it and they say, historically, we're really high. Here it is. Let me put it back up. There it is. This is from they have the Schiller PE on this, but this is just the PE. So we can look at it and we can say, wow, that's pretty high. I mean, it was higher here for like 5 seconds, but the thing that gets missed in this is that you've got to also factor in the interest rate, because interest rates dictate asset values. The lower the rates, the more expensive an asset will be. And so I don't say that to suggest that that the current market is cheap. But what you can't do, for example, is compare this market to this market over here, or this market here to whatever, this market here. You've got to consider interest rates. Now, of course, if we conclude that maybe the market isn't as overvalued as we might otherwise think because interest rates are low, that does then beg the next question. What happens when interest rates go up? And I think the answer is, yeah, asset values go down. And then the question becomes, well, Rob, when are interest rates going to go up? And I have no idea. So back to your question, though, do you have a withdrawal strategy? So we've talked a lot about this. I would recommend my video series on the 4% rule. The one thing about the 4% rule, though, is that I don't think most retirees actually follow it. They might start by taking 4% out in year one, but remember what the rule says. It says you start at 4%, whatever that number happens to be for you. If you got $1 million, it's 40 grand. And then regardless of what's going on in the world, we could be at war, doesn't matter. You're going to adjust that 40 grand for inflation each year. And you're going to do that even if inflation is 15% and the market just dropped 50%. And that's what Bill Bengen looked at. And he looked at it, think about it, he looked at it from 1926 up into the 70s. So, the Great Depression, the stock market crash, World War II, Korea, Vietnam, and he just ignored all that and said, okay, this is what we're going to do each year. I don't know that I would do that. Would you do that? I don't know. Would you just sort of go about your merry way, taking out your inflation-adjusted amount every year, regardless of what's going on? So, James, to answer your question, the thing that I think, particularly if you're going to need somewhere around 4% in year one to survive, like if you can live off, say, 2%, then you got all kinds of flexibility, not only about how you take it out and, but how you invest your money, because you're spending so little relative to what you have. But if you're going to need 4 or 4.5%, the approach I like is the approach where you put guardrails. That's just the term they came up with it, on your withdrawal. So you might start in year one, let's just say at 4.5%. And you might decide to adjust for inflation. But rather than doing that, regardless of what's going on in the world, you'll set up guardrails, just like guardrails keep you from driving off the side of the road. Well, these help you from completely wrecking your finances in retirement. And so there's two. And the one that Michael Kitces has recommended, Kitces, he's got a great blog, he's a CFP. Actually, he's got like a string of like a dozen different letters behind his name, I think. I just have JD. Anyway, at the upper end, he says 6%. So he says, you know, do your inflation adjustment, figure out what the number is, but then take that and divide it by your total portfolio and make sure you're not taking out more than 6%. If you are taking out more than 6%, which could happen if inflation's high, in particular if the market goes down, pare it back to 6%. Don't ever take out more than 6%. That's the guardrail. And on the other side, always, well, assuming you want to spend the money, always take out at least 4%. Because you could do the math, say if inflation's really low and the market went sky high and you take your inflation adjustment and you do the math and you're only taking out 2.5%, or 3, that's probably unrealistic, maybe 3.5%. What Kitz has said is, if you want to spend more, go ahead, but don't, on that end, don't go above 4%. And he didn't back test it. I gotta believe though that that's probably in the right range to be thinking about. But to me, that kind of approach, whether you follow those exact numbers or not, it makes a lot more sense to me. I think it's a lot more practical. You know, yeah, that's my take. So you could Google that. I've done some videos on it. I'll do some more. So you could look back in my video library on YouTube. There are a number of papers on it. Maybe I'll do a video that sort of summarizes all of the different sort of guardrail approaches. That might be worth doing. Okay. Let's see. I got to work on this chat function because as soon as I move the cursor, here we go, it just drops all the way down. All right. Roger says dry powder is a fallacy. Cash is guaranteed to have a negative real return. That's certainly true. Although I think what like a Warren Buffett would say is, I'm okay losing money on cash, you know, on an after inflation basis for a while, because I can wait until whatever the market does what it does, and I can buy at really low prices, and that will make up for the money I lost. Now, he hasn't called me and told me that's what he thinks, but that's what I'm guessing. Fast Eddie, hello from Fort Worth. I'll be down your way soon, going to FinCon. It's a conference of personal finance bloggers. It's in Austin, not Fort Worth, but it's close. Okay. If this is Vinyl One Earthlink, if you are a good stock market investor, the first step is to admit you have no idea what will happen in the future. I think that's true, at least as far as the markets. Salty says Warren Buffett is rich, he doesn't need the money. That's true, I guess. Well, it is true. Andrea says, Rob, great content. I'm almost caught up. It's helped me revolutionize my finances and plan to retire early. Nice. Curious, do you read or study any behavioral finance books, resources? There's one, The Psychology of Money, that just came out that got really good reviews. I've not read it. I've certainly, I don't know that I can think of, and I'm pulling it up, I don't know that I can think of a good book that I've read recently. Here it is. Yeah, look at this. It's got 14,000 reviews, and it's got an average of 4.7 out of 5. I've not, as I said, I've not read it. Probably worth a read. I certainly give a lot of thought to behavioral finance, which, by the way, gets back to that whole 4% versus guardrails. I mean, that's not just a function of behavioral finance, but that's a big part of it. But I don't know that I have any books I can recommend other than the one I just showed you. But again, I've not read it, but it's gotten good reviews. Vinyl, I'm just going to go with Vinyl. Why don't you think you can value a company better than Buffett? He's made tons of mistakes. I don't know, but it seems to me unwise to suggest I can do anything better than Buffett when it comes to investing. But seriously, he has made mistakes, which tells you how hard it is. And he'll be the first one to tell you he's made mistakes, but he's gotten a lot more right. And by the way, he wouldn't view as a mistake, I don't think, missed opportunities. All right, what else we got? Greetings from the Philippines. Welcome. We get a lot of international folks here, which I think is great. This has got to be the all-time best question from John. What to do with short-term money, say 500 grand? Well, first of all, I can just say from my own experience, I've never viewed 500,000 as short-term money, but hey, you're a big spender. I don't know what I would do with 500 grand. If it were truly short-term money, that means what? I need to spend it soon? I'd stick it in the bank. Probably 2 accounts to get that FDIC insurance. All right. Hannah, welcome. It's my first time to see Rob doing a live video. Glad you're here. What else we got? Another person sitting on 400 grand. I mean, my goodness. I should start charging for this. Topher says crypto only. That's not a good way to go. I can't agree with that. So Vinyl says, Rob, I guess your mistake is not knowing who Charlie Scharf is. Well, who says I don't know? Okay. And what skill he has to turn Wells around. He's a fabulous exec comparable to Diamond. Well, I'm a buy and hold investor of Wells Fargo. Right? I don't know. So I got no problems with Wells Fargo. What else we got? Now, the crypto guy is saying he's up 700% past year. That's terrific. I mean, that's phenomenal. I hope you've sold, but anyway. What else we got? You guys are back and forth on Wells Fargo. Okay, here's a question from Salty. How do you go about optimally consolidating many accounts and firms, old 401ks, IRAs, brokerages, and so forth, into a 6-fund portfolio? And then, there's a question of taxes. Well, so obviously if it's in a tax account, a tax advantaged account, it's easy, right? You don't have to worry about taxes. And you don't have to consolidate them into one account or just a couple accounts. I mean, you can do a 6-fund portfolio spread out over a dozen accounts, and there might be a good reason to do that, right? You may have a 401k, your spouse may have a 401k, you both might have Roths, you both might have rollovers, you both might have HSAs, you have a taxable account, and so you may not be able to consolidate those accounts. And that also may mean you have to implement the 6-fund portfolio or a 3-fund portfolio, or, whatever, using different mutual funds in each account. So, my wife's 401k and my 401k, for example, might not have the same investment options. That's fine. Now, for those listening, you're wondering what a 6-fund portfolio is. So a 3-fund portfolio is just, you've got, say, a U.S. Index fund, an international index fund, and a bond index fund in some percentages. 3-fund portfolio. There are 3 asset classes that I have historically added to that. Small cap, sometimes small cap value, emerging markets, and REITs. So that's my definition of a 6-fund portfolio. You take the 3-fund portfolio and I tended to add 10% in each. I'm actually now shrinking that, and just to simplify things. But in terms of taxes, and I've gotten this question a lot, where some people may have individual stocks and they want to move to index funds, or maybe they had an advisor who put them in a lot of sort of actively managed funds in a taxable account, and so they've got these built-in gains. And you just have to work with a tax accountant, and you have to make a very difficult decision, and that is it worth taking the tax hit to get that money into an index fund? And I can't answer that for you. I can tell you, I'd be looking at what fund it's in now. Even if it's an actively managed fund, that doesn't mean it's a bad fund. It may not be one I would choose, but there are plenty of good actively managed funds, right? So is it worth the tax hit? May not be. Obviously I'd look at my tax bracket. Can I do this over a number of years to spread the tax hit out? Are there lots within a fund where maybe I can sell certain lots rather than doing sort of the average price for tax purposes. You could look at that. If you have any, are there possibility for tax losses? You can offset some of the gains. Is there going to be a year, where maybe your income's going to be lower, and maybe you retire before you start getting Social Security, and there's going to be times when you can actually pay 0% potentially on long-term capital gains, or maybe just a lower amount, 10%. So those would be the kinds of questions that I would be asking. But I think you're absolutely right to consider all the tax implications of the decision, for better or worse. Rico says, your take on contributing to a 401k beyond the company match versus only contributing to the company match and using the difference towards taxable account. Well, so the first question would be the money that you might contribute beyond the match. What's it for? Is it for retirement? If it is for retirement, I would keep it in a retirement account. Doesn't have to be the 401k. I could open up an IRA, whether it's a Roth or a traditional, and I might do that because I can choose where to open the account, and I might have more control over the investment options. So there might, and the rules on getting money out of an IRA even before you're 59 and a half are different than the rules for 401ks, and in some cases they're better, in some cases they're not. But if it's for retirement, I would want to keep in a tax advantaged account. That's the choice I would make. If your concern is you may need the money, a Roth IRA is an option because you can always take out the contributions, not anything you've converted. That's a different rule. But your contributions to a Roth IRA, penalty and tax free, because you've already paid taxes on them, not your earnings, the contributions. Of course, you may not qualify for a Roth IRA, and then you might do a traditional IRA, which may or may not be deductible. If it's not deductible, which depends on a number of factors, not only your income, but whether you're married or not, and which seems crazy, but it is, and whether your spouse has a retirement account at work, and a lot of rules for that. You could think about a backdoor Roth IRA, which is a whole nother topic. But if it's for retirement, I'm going to tend to lean on keeping it in some kind of retirement account. All right. This is a great question from Joe Burns. How would you weigh a pension in a portfolio? Would you count it as a bond? So there's two questions there, really, because you could look at it from the perspective of you're still accumulating assets, you haven't retired yet, and then you've retired. I tend to think of this question in terms of once you've retired, and I get the same question: how should you think about Social Security? Here's my approach. The very first thing first thing I would do, I'll answer it this way. If I had a pension, which I don't, if I had a pension, I would say, okay, it's going to generate X dollars. How much more do I need? What do I need out of my investments to live on in retirement? Let's put it that way. I may have a pension, Social Security, annuities. I may have a part-time job in retirement. I may start a YouTube channel, make $4 a month. After I factor in all that income, what do I need from my investments, right? And the reason I do it that way is because if you're going to need something approaching 4%, I still think William Bengen's analysis is the starting point. And what he said was, you need 50 to 75% in equities. And that more or less hasn't changed. A lot of people have looked at this. I think it comes in around the 65% mark. You could argue that today it should be a little different because of yields. Okay. But somewhere in that range, I think, is the right answer if you need to generate in year one of retirement something close to 4%, whether you adjust that automatically for inflation or use guardrails. But if you're going to need that, the fact that you have a pension over here doesn't change your investments. And you're still going to need whatever you're going to need from your investments, you're going to need it, even after you factor in all your income sources, right? Your other income sources. So that to me is the starting point. Now, if it turns out that because of all your other income, you don't need 4% from your investments or anything close to that, maybe you could even you could go a year without taking anything out. You could survive on Social Security, pension, annuity. Then I think you've got a lot more flexibility now, because you've got these options. You could forego a distribution 1 year from your investments. That's a huge benefit. And where that will lead you, though, I think depends on each individual. I think for a lot of people, where that will lead is taking on more risk. And the reason, in part, might be you want to leave money to your children, your grandchildren, to charities, and I think those are all good things. And there you've got a lot of flexibility. But for me, the starting point is with factor in all the income you're going to get. That's great. How much do you need out of your investments after that? And again, if it's close to the 4% mark, then I mean, then almost the other income doesn't matter. If you had $1 million saved and you need 40 grand of that in year one, and you need to sort of keep pace with inflation more or less, then that's just the reality you live in. I mean, that's no different than someone who doesn't have all the other income and has $1 million and needs 40,000, right? That's my take. That's another video I plan to do. Maybe I could just cut out that last 2 minutes and publish it. I don't know. So Vinyl makes a point that I hear a lot. He says, if you're in the S&P 500, then 30% of your portfolio is in 6 large tech companies. That is absolutely true, and I will prove it to you. We'll go back to our good friend Morningstar. We'll just look up VU, which is Vanguard's S&P index fund. We'll go to the portfolio tab right here, and we'll scroll down and we'll look at their top 10 holdings. So it's not really quite 30%, I don't think. 6, 11, 14, we'll call it 15, 17. It's 20 plus 25%. So it's a big number. And that's true. And people make a point of that. The percentages vary. If you look back in time, there are times when the top, 10, we'll call it, represent a smaller percentage than they do today. But it's always a pretty significant percentage. But I'm okay with that. I mean, you still look at the history of the S&P 500 and it's done really well. But it's something to note. It's true. But also, I think for most people, they diversify beyond the S&P 500 too. Restoration asks, how do you invest in carbon credits? My answer to that is I have absolutely no earthly idea. If anyone wants to answer that in the chat, I don't know. Roger asks, Rob, I know you use Morningstar. Yeah, that's true. It's right there on the screen. Are there other info sources that you rely on? So I've used Stock Rover in the past. That I think, and I'm learning more about that tool. It's particularly, I think, probably a good tool if you invest in a lot of individual stocks. I don't use stock screeners, but it's got a stock screener. But I would say Morningstar, in terms of evaluating, like getting details on companies and mutual funds, it's primarily Morningstar. To understand my portfolio, it's Personal Capital, Portfolio Visualizer. I've been working with New Retirement and understanding their tool. And there's another one that I've been looking at that someone mentioned called Ripsaw. Anyone use Ripsaw? If you do, leave a note what you think about it. All right. Joanne says, hi, Rob. I love your channel. She's from Dublin, California. Well, thank you. Glad you could join today. What else we got? Zane says, do you have any thoughts on much younger investors going more for QQQ than the S&P? Well, I still, if I were investing for my children, and to some extent I am, I guess, I would stick with the S&P. And it's not that I think, the QQQ, for those that don't know, I've just pulled it up on the screen, is what? I actually am, it's interesting, I still work for Forbes. I was the founding editor of what's called Forbes Advisor. Now I just write one article a month. And the article this month was the best, it hasn't been published yet, but the best growth, large cap growth ETFs. And QQQ made the list. Even it's interesting because QQQ is not technically a growth fund. It's the top 100 in the Nasdaq, right? It just so happens if you look at the portfolio, pretty large and pretty squarely within the growth style box. But the problem, it's highly concentrated, right? Even more so than, you're talking about 30% in the top 6 in the S&P. Look at this. The top two are 22 over 22%. And then the top three, you get to 30. So this is really concentrated. And I would be a little nervous about substituting the QQQ for the S&P 500. You know, when it wins, you win big. But when it loses, you're going to lose big. You could do both, though. You could own both, some percentage in QQQ if that, you know, if that's what you need to, you know, to add a little spice to your investments. All right. Okay, so so Dan gives us a flat fee advisor. I'm going to actually Google this person. Let me, just in case, I don't know, you never know what Google's going to return. Let me take the screen off. Let me look this person up. I'll tell you what I'll do. I'll do more research. I'll do some more research. His name is Andy Penko, if I'm pronouncing it right. Here he is. So I'll check him out. Don't know anything about him, but thanks, Dan. That's exactly the kind of info I want. Who are you talking against the spread? Buckeyes -14 or the Gophers? Go Goldie. Really? I don't know. All right. I see. I'm catching up to the chat where you guys are laughing at me because Siri scared the crap out of me. Jonathan says this is how horror movies start. That's right. They start with talking about an index fund, and then it all goes to hell in a handcart. All right. Bill Gross, apparently, according to Topher, says that bonds are trash. Yeah, I mean, bonds are expensive. There's no doubt about it. Minna asks, what do you think about QQQ, which I kind of just talked about in response to a different question. And VGT, is that the growth fund? That's VUG. What's VG? I never can remember. That's not VGT. VGT. Oh, it was kind of the same thing. I mean, it's not, but information technology. It's the same. My answer would be the same. Although I haven't looked at this closely. Let's look at their portfolio. First of all, Stylebox is almost identical to the QQQ. It not 100%. It's close though, right? And if we look at the portfolio, yeah, look at this. This is even more concentrated. Look at 20% of the portfolio is in Apple. 37% in the top two companies. That's amazing. Yeah, again, I certainly don't see that as a substitute for the S&P 500. If you wanted to overweight technology, yeah, you could use either of these funds to do that. Again, if it, I mentioned in a previous video, if you've got an itch that you just need to scratch 5% or 10% of your portfolio or whatever, for me it's individual stocks. If it's technology, I get that. Here's the trick. If you put 10% in this or the QQQ or whatever the relatively small percentage is, will you stick with it when it's underperforming for 5 years? Because you're going to have to do that. If you don't and you sell out, and then the day will come when it starts to do what it's been doing here lately, and you'll buy back in, and you'd be better off, in my opinion, just sticking with the S&P 500. Yes, international companies can pay qualified dividends. Someone made the point. I can tell you in my fund, I'm getting a lot of dividends that aren't qualified. What else we got? Andrea asks, what can I do if my 401k plan doesn't offer index funds, only proprietary high-fee funds, and a target date with 1.1% expense ratio? Cannot do in-service rollover, which means sort of taking the money and putting it into an IRA while you still work there. You can always do that after you leave. Some allow you to do it, they call it in-service while you're still employed. This one does not. And my work hasn't shopped for a better plan. Well, let me just first say, I'm a little surprised that it must not have automatic enrollment, because with automatic enrollment, they've got to put the money in a fund, and that creates all kinds of legal landmines for companies. And so what they tend to do is put it in like, a target date retirement fund or some kind of index fund. So it's surprising that they don't have any index funds. So one option is I would continue to work with HR to try to get better options, and I've had to do that in the past. I worked I think it was when I worked at the Public Company Accounting Oversight Board, which regulates auditors of publicly traded companies. I think they didn't have great options, and we worked with HR. Eventually, they got better options. I think that's where it was. But that could take time. It's not going to happen overnight. If they have a matching, I'd probably stick with not great funds to at least get the match, and then I would invest elsewhere, like in an IRA. I mean, that's really the best you can do that I know of. But I would, and I'd get other employees. I mean, I'd try to do it smoothly. I wouldn't get pitchforks and torches. But I would try to encourage them to do better. All right. VGSTX. I think we looked at this one, right? Let me just make sure. That's the international, right? VGSTX. Oh, no. This is the actively managed fund. Vanguard Star. 31 basis points. Large blend. I don't know a thing about this fund. Look at the portfolio. So it's close to growth, right on the edge. I'm just scooting down to the holdings. Oh, so it in turn holds other Vanguard funds, which is unfortunate in a way because it makes it a little harder to evaluate it, right? Let me jump over to Portfolio Visualizer. I can show you on the screen. We're going to go to this tab right here, Backtested Portfolio, and we can put the ticker in, which again was, let me highlight it in my screen so I don't lose it, VGSTX, right? There it is. We'll do 100%, and we'll just compare it to VU. That's 100%. And I don't know how far back will this go. It goes back to January 2011. And yeah, it's really underperformed, at least in that time period, by quite a lot. It's not as volatile. It's got that going for it. If we add in a stream of contributions, call it $250 a month, because that can change the analysis. Yeah, still S&P does better. The reason I do this, you always hear past results are no indication, of the future. And that obviously that's true. For all we know, this fund will outperform over the next 10 years. Maybe it will. But I always ask myself, why the burden is on moving. If I'm going to move away from the S&P 500 to some other fund, I think like a lawyer, the burden of proof is on the other fund. They have to prove to me that they're worth my money. And when you've underperformed the S&P like this fund has done, even though it's still it's not like in a different asset class really, right? I mean, although I didn't look, does it have international? See, this is where I need to look at the whole thing. This is a balanced fund, so forget everything I just said. This is a balanced fund, so no wonder it didn't keep up with the S&P 500. It's got not only international, but it's got fixed income, right? So to evaluate, this is almost, you can almost look at this as a three-fund portfolio all in one, right? The only difference is if you take this route, the plus is it's one fund and you're done. That's good, right? The downside is, unless you're going to add other funds to your portfolio, you can't control the percentages, right? They're set by the fund. So we could look at this fund in Portfolio Visualizer. We could say, all right, Rob didn't know what he was talking about when he just started blathering on. Now that he's at least got some idea, we can compare it to the three-fund portfolio, and we can put it in rough percentages, 41, 21, yeah. So we'll call bonds 35%. This was what, 41, that's 76, what, 24, did I get it right? Am I way off? There we go. And we can analyze this. And Portfolio 1 has beat it. There you go. I would, probably look at it more closely to understand why. If I could, I may not be able to answer that question, at least with any level of confidence. And that's okay. I need to be able to say, I don't know. I don't want to force an answer if I don't know it, but that would be the first thing I'd look at. The second thing I'd look at is, do I like these percentages, right? Because if we come back up here, and I know I'm jumping around a lot, I hope this is helpful, and we put in the original allocations that you start with. This is sort of the boilerplate 3-fund portfolio, which is 50 US stocks, 30% international, 20% bonds, and we see how it's done. Look at that, it's underperformed. That's interesting. My hunch is, I don't know why. I'd have to do more research. Fascinating. I know international is underperformed, but again, this fund, it has less international. That might be the answer. I don't know. I'll dig into that more. Maybe do another video or a video on Vanguard Star. And it's done fairly well. All right. Sherry says Discover seems to have a good interest rate and they've ranked well for customer service. Not much in terms of brick and mortar though. Yeah, Discover has a bank. I don't know what their rates are. I think they're lower than. I think they're lower than Axos though. But the rate's not the only thing. But I guess for online savings accounts, it's the main thing. Yeah, they're at 40 basis points. But good, yeah, good customer service. Zeke Bose says GM write notes 1.5% from first dollar. ACH transfer supported. I'll have to look those up. No idea what that is. Sachin says, what do you think about concerns that are being raised about excessive index fund ETF investing, which could impact price discovery in the market and could cause a bubble? It's an interesting question. The other concern, by the way, has been that the voting of shares, where a few large index fund providers have more control. Right now, I think there's plenty of price discovery. And you see it still in the volatility of the markets. I mean, you know, to my mind, the markets aren't any less volatile, which you'd think they might be if we're all just index fund investors buying and holding. So, and by the way, you can be an active trader with index funds. So I don't know. I think it's something worth keeping an eye on, but I just haven't seen it yet. We'll see. All right. In the event of hyperinflation due to the devaluation of the dollar, how do you think we should invest or prepare? Yeah, that's a great question. I think it's very difficult to prepare in the form of doing something with your investment portfolio. It's kind of like, you know, when people say we should have been more prepared for COVID, and we can certainly look at preparation for something like that and see where we could have improved. But here's the problem. There are a million different ways disaster could strike. You simply can't prepare for every way. It's just not possible. And so yes, when one does strike, we always ask, why weren't we more prepared? Well, and maybe we could have been, but you just can't prepare for everything. We could prepare for hyperinflation, but what happens when rates go negative and we're Japan for the next 20 years? We don't get any growth. How do we prepare for both? You know, you could put, and to make matters even worse, if you think of an investment, like if you just think gold is the way to go, for example, to deal with that problem, or I don't know, Bitcoin, or pick your asset. How much do you have to put in that asset now so that if hyperinflation happens, it's actually enough to save you? Well, a truckload, right? I mean, you can't put 2% in gold and say, well, if hyperinflation takes off, I'm fine. I've got 2% in gold. I guess unless you're a billionaire. You know, so I think it's really hard to prepare a portfolio for black swan events, right? You certainly can be as diversified as you can be, is one way. It's one of the reasons I have international funds, even though I think there are good arguments why you don't need them. I haven't moved to gold. Maybe I should. I don't know. I'm always open to new things like that, but I haven't. I try to prepare outside of my portfolio. Well, how can I just survive? Do I have other streams of income? Am I keeping my skills sharp? Am I keeping my debt low? those are sort of the ways I think about it, rather than what's the perfect asset allocation in case this happens. Because the this, you're going to have to multiply by 100. There's 100 thises that could happen. And we don't know which one it's going to be or when. And you just can't prepare for them all. So, yeah, I don't know. That's my take. And actually, let me just see here. Jonathan says, hyperinflation is a tough one. If you're at the point where buying bread gets twice as costly every day, you better have already bought flour. Yeah. I don't eat bread, so I got that going for me. All right. Dan mentions a fund. He doesn't actually ask a question, just drops a fund in the chat, and I want to look at it. It's a Vanguard fund, and it is a tax managed fund. So meaning you'd hold this in a taxable account. The idea is they manage it in a way to keep taxes low. I'll have to look at this more closely. I've heard of it, but I've never owned it, and I've just not done much with it. Is it just tax managed large cap? Looks like it's just a tax managed, like a Dow Jones. It's not an S&P. There's 800 holdings, almost 900. There's a Dow Jones index of U.S. large cap, although I think that's got about 750. I'll have to check this out. I wonder what its distributions are. I'll have to look at it. What else we got? Regal wants to know, will you ever do a video on creating trusts? Yeah, I can. I'm not a trust attorney. And there are good reasons to have trusts, particularly as part of estate planning. You can have a revocable living trust, which we have them. I mean, you can use revocable living trusts. You can have them and only use them once you die, effectively. Or you can actually put things in them now, and some suggest doing that for a couple of different reasons. But yeah, I can work on a video on trusts. Yeah, hopefully I'll remember that when we're done. Roger says, your humility is refreshing. Most lawyers seem like know-it-alls. Some would say I sometimes seem like a know-it-all, but thank you. The problem is, once you've done this for a while, and by this I mean invest, you realize how wrong you are so much. I mean, I was confident interest rates would rise in 2010. I didn't invest based on that belief, but I mean, I was sure. All right. Jonathan wants to know, what kind of law did I practice? So I'll tell you my story very quickly. I graduated from Boston University Law School in '92. I went to the firm of Winston and Strawn. It's an international firm headquartered in Chicago. I worked in DC. I was a litigator. Did a little bit of everything. I actually defended Dan Rostenkowski. Anybody remember him? But I was mainly just commercial litigation. I ended up moving to technology-related litigation. You know, I worked with Accenture, AOL when they were, a big deal, Gateway, a computer company, different consulting firms. I ended up going in-house. So I was there, I made partner, then I almost immediately left. And making partner is like winning a pie eating contest, only to realize that more pie is the prize. I went to I went to KPMG Consulting, worked in-house just for a couple of years. And then I made a left turn. I went to the Public Company Accounting Oversight Board, which regulates the auditors of publicly traded companies. It was a great job, love that job. It was in the enforcement division, so I investigated auditors that we thought maybe didn't do a good job auditing the financial statements of public companies. I did that for 6 or 7 years. Then I went back to my old firm, Winston & Strawn, and defended auditors. And then I retired. How much is healthcare in retirement per month? Well, if any retirees out there can answer that one, I wouldn't mind knowing that myself. All right. What else do we have? Dan likes the idea of guardrails. I think that's the way to go. If you're close to that 4%, makes a lot of sense. Salty wants to know if I'll play in other Virginia tournaments. Don't see you were ever in Fredericksburg or the Virginia Open. So I guess, Salty, you play. I am playing in another tournament. This one. You can't really read that, can you? The 12th Annual Washington Chess Congress. It's October 7th to the 11th in Reston, Virginia. I'm playing in that chess tournament. If anyone's there, I'd love to talk with you. What else we got? GoCuse, I think I'm pronouncing that probably not right at all, says, how about with the 11 sector investment strategy, you keep the allocation equal among the 11 sectors? Yeah, that's an approach. And you even have equal weighted indexes, right? Because the S&P is a cap weighted. That's why Apple gets more of your dollar and Microsoft gets more than the smaller companies. The theory, by the way, I think for cap weighted is just we're just going to sort of mimic the market. Wherever the dollars, the capital flows, that's what we'll do. So you could do equal weighted. I don't know how that would perform. There may even be an equal weighted, I'm sure there is an equal weighted sector ETF. I tend to, again, to me, the burden of proof would be on that fund. And if you have one, we can look at it. But I've never owned an equal weighted, a fund that's equal weighted. All right. Double Dog wants to know, which fund is your biggest holding? Well, the answer to that question is probably not that meaningful, but it would be the U.S., S&P 500 would be the answer, I think. Or yeah, the only reason I hesitated is for tax reasons. I sometimes switch between that and a total market, but that's just a function of my asset allocation, right? All right. What else do we have? Hannah asks, is the 4% of the original balance adjusted for inflation? I think. Yes, it is. I don't know if that was a question or you were responding to someone else. You take out 4% in year one, and then starting in year two, you forget the 4%. It's irrelevant. Whatever amount that generated for you in year one, what Bill Bingen did in his paper was adjust that amount based on CPI, inflation. Dan asks, dividend payout versus total return. I'm not sure what the question is. I focus on total return. By the way, after my free dividend fallacy video, people will say, Rob, I don't understand why you hate dividends. I'm like, I don't hate dividends. I love the dividends I get. By the way, I love all the returns that I get. I don't love dividends more. I love total return. And dividends have some downsides. They have some upsides. And if you get excited by the dividends, that's great. You should. I do. I track my income from my investments in personal capital. I'll go to the cash flow and I'll go to the income tab, and then I'll only select the investment accounts and I'll look at the income it's generated and I'll just stare at it for hours on end. Well, that part's not true, but yeah, I love my dividends. I just don't want to love them too much. I mean, I don't want to tilt my portfolio towards income, because that's, in most cases, particularly if I tilt it significantly. It's one thing to have a dividend fund, and in fact, I'm going to do a video on some good dividend funds. That's fine, it's money in that, but people go overboard. They watch YouTube videos that say, get 10% dividends. Like, that's not probably a good thing to do. All right. Here's an interesting question. Raul says, why is a long-term loan to buy a home considered great, but using similar long-term leverage for stock considered high risk? Can you explain? Well, it depends on what you mean by a similar long-term leverage. When most people think about borrowing to invest, they think about borrowing on margin, right? Now, and I'm guessing that's not what you mean, and I'll come back to that. But the problem with margin is you can get a margin call, right? When stocks go down, you can be forced to effectively sell shares when the prices are falling to pay off the debt. And so when you borrow like that, it can really magnify your losses and put you into a pretty dire financial situation. So I don't believe in borrowing to go out and invest. Now, someone can say, well, wait a minute. Let's say I've got my home paid off and I want to do a cash out refi for 30 years at today's rates of 2.75% or whatever the rate is. And I'm going to put all that money in an S&P 500 index fund. What's wrong with that? Well, if we assume that you can pay the mortgage comfortably with other money, right? Not your investment account. You've got a job, you've whatever, and you can pay that money, it's probably fine, actually. My hunch is you would turn out ahead. You're not relying on the investments to pay the loan. You can let them sit there through good times and bad. Rates today are at historic lows. If the market crashes by 50% later this year, no big deal. You don't need that money to pay the loan, and you can let it sit there for 3 decades. You'll probably be fine. When people talk about borrowing to invest, though, that's not normally what they talk about. Now, having said all that, we could do that. We could do a cash out refi on our house and put the money in the S&P 500. Why don't I do that? I don't need to, and it complicates my life, and I don't need to enjoy life. And, I want to be responsible and smart with our money, but it does add some risk. Maybe it's small, but yeah, I don't need it. And I generally don't like the idea of borrowing to invest, even in those circumstances. Of course, someone could say, well, if you have a loan on a mortgage on your house, and rather than paying it down as quickly as you can, you're investing in your 401k and your IRA and taxable accounts, aren't you effectively kind of doing the same thing? Yes, but not really. I mean, it's similar, but you're not actually going out and incurring debt so you can invest. You went out and you incurred debt to buy a home. And I don't believe, like Dave Ramsey does, that you should, well, that's not true. I don't think he does believe this. He has you save 15%, right, before you start tackling the house. So anyway, that's my answer. There may be some internal inconsistency to my approach. I get that. You could come up with some different scenarios where you're kind of using borrowed money to invest. If you think about money as being fungible, I get that, but I still think it's different. All right. Cheese said, I invested my down payment money into VTI, 70 grand, stocks to the moon. Diamond hands, man, diamond hands. All right. How does crypto make money? It's a great question. It doesn't. It doesn't make money. Neither does gold. People may buy it in the future for more than you paid for it, but it's like a barrel. Buy a barrel of oil and stick it in your garage. It doesn't make any money. All right. So this is from an earlier comment about Wells Fargo. Vinyl was saying his point was you sometimes buy a stock based on the CEO who can turn the company around if you think he can do it. Clearly, when you're buying stocks, the management is critical. Think about this. Maybe I have too much time on my hands. Let's imagine you owned a business, whatever, dry cleaner, and you decided you were going to hire a management team to take over. You don't want to manage the day-to-day. And the management team came in. They're great. They know how to run a dry cleaner. They're good with their employees. They're great with the customers. They care about the business. Wonderful. And then you're about to sign them up, and they say, wait a minute. We have one condition. What's that? We have complete control over the money in this business. We decide how much to reinvest. We decide what to reinvest it in. And we decide whether to pay you, the owner, a dividend, when to pay it, how much to pay it, or maybe not to pay it at all. Well, if it was your own business, you probably wouldn't agree to that. But when you buy the stock of a company, that's exactly what you're agreeing to. Because I can't call up Sharf or Tim Cook or anyone else and say, you got to do things differently. I'm an owner here, don't pay a dividend or pay more. You're basically turning the keys over to someone else. So, if you're in index funds, you just buy the index. Some companies will do well, some won't. That's okay. When you're buying individual stocks, you got to know the management. All right. What else we got? Carnivore Nurse. I'm not even sure. Okay, great book up here in Alaska. I've been to Alaska, Skagway. If anyone been on the cruise that goes into Skagway and you get on the White Pass and Yukon Railroad and you take the train up the mountain, they were a client of ours. So I would fly to Skagway. We'd get to Juneau and they'd put us in a 4-seater. I'm literally fresh out of law school in this 4-seater. The pilot's right next to me. They got the yoke right in front of me. I'm like, oh. And we take off from Juneau and I fly to Skagway. It was fabulous. We stopped in Haines. There's a bald eagle sanctuary. Unbelievable. Anyway, that's not really Carnivore's question. Rob, can you review an all-index stock portfolio for a young investor? 60% U.S. total market, 20% international, 20% small cap value. I don't need to review it. I think it's a great fund. I think it's a great portfolio. Yep. Now, there's no bonds. So, it's going to be a ride. You're going to have to, be willing to stick to that when the market's down 40% or whatever, and it will be. But you're young. I'm going to read that as 20s. And so you've got decades to go before you need the money, I'm assuming, for retirement. I like that portfolio. I think it's great. All right. Well, we got an answer. Number 1 is false. Buybacks raise the share price, are more economical for the economy, for the company, and the shareholder who may have to pay income tax on the dividends. Yeah, definitely a lot of advantages to buybacks. Sometimes I get concerned that management uses buybacks because dividends reduce the value of the company per share, right? But with a buyback, you're spending money, but then now there are fewer shares out in the market. Sometimes I wonder if there's some self-interest involved. So that's, again, where management really matters. But yeah, if you look at, here, look at this. Let's go back to this for a second. Here's Apple. We looked at this, but they spent $14 billion right here in dividends. They spent $75 billion in common stock repurchases. That's just, or 72, excuse me. That's just 1 year. Yeah, so they're buying back stock. Salty, I don't even understand that question. Oh, the Grob. No, in round 8. My opening selection in chess is pretty mainstream. James says, I consider my pension a bond in my investment decisions. There was, if you Google, let me do it for you. There was an interview, Christine Benz, Morningstar, interviewed Michael Kitces, I mentioned him earlier, pension, let me see if I can find this article. Pension, asset allocation, Morningstar, Kitces, see if I can find this. Here it is. Here's the article. And there's actually a video with it, which I haven't watched. But here's the article. Christine Benz, we had her on the show. She interviewed Michael Kitces, who I mentioned before. And he talks about this sort of issue. He was talking about more Social Security, but it's the same idea. And what he was saying is Social Security, because it's adjusted for inflation, it's kind of like a TIPS bond, right? And if your pension's adjusted for Social Security, or adjusted for inflation, then you could see that like a TIPS, and you could calculate the present value of that pension, right? It's going to change as interest rates change, because interest rates affect present value of everything. You could do that. Again, I still like the idea, though, of looking at the investment. The difference is, if you own TIPS, you control the capital, the principal. With a pension, certainly with Social Security, you don't, right? You can't liquidate your Social Security. You get a check every month. That's what you get. And that may be true with your pension as well. Sometimes you can take a lump sum, but the point is you don't have actually control over that asset. So I still like the idea of looking at investments and, okay, what percentage do I need? If it's close to 4%, I still need that even with the pension. But it's an interesting article. You might want to check it out. He likens Social Security to TIPS. All right. Yeah, I agree, Vinyl. We'll see if it takes off. I did go over 20,000 subscribers. Yeah. I think I get like a plaque from YouTube if I go over 100,000. What else we got? Thanks, Roger. Roger tells me I'm well worth $4 a month. Do buybacks raise the share price? And that's a question that Vinyl directed at George. It's an interesting question. I'll let you guys debate that one amongst yourselves. So Bebe asks, he says, I think, both me and my husband work for the state government with alternative plans, not a pension. Will not have Social Security. Should we convert some of our retirement funds into an annuity or a pension? I don't know if you can convert it really to a pension per se, but you could certainly buy an annuity, right? So the first thing I would do is I would talk to a flat fee only advisor who's not going to sell you anything. In other words, if you end up buying an annuity, you're not going to buy it from them. And I would go show them all of that's what I would do before I ever bought an annuity. I think sometimes it makes sense. One of the interesting things that I'm working on for another video, I've been reading a lot about it, is when you annuitize your retirement, there's pros and cons to that. One of the advantages is you get this sort of guaranteed, at least guaranteed based on the insurance company that sold you the annuity, this guaranteed income. Of course, there's a downside. You don't control the principal. And if you die, in most cases, there's nothing for your children, for example, to inherit. Of course, you don't have to annuitize everything, right? But the point I want to make is they found that when you compared two people, one had an annuity for retirement and one had, say, a comparable amount invested in whatever, an IRA, the annuity people spent more money. It was as if they felt comfortable. They knew they could spend their whole check and another one was coming the following month or the following quarter or whatever. They didn't have to worry about it. But the investor, in the stock market was scared to some extent. Markets go up and down. And so they were like, oh, I don't want to spend too much. I don't want to run out of money. And when you looked at it long term, the annuity folks sort of had a more enjoyable, if you want to measure joy based on how much you spend, retirement, which I find fascinating. And I can understand why that would be. But to your question, it may make sense to annuitize some of your your retirement money. There's pros and cons. I would, if I were going to do it, I would do a fixed immediate annuity. I wouldn't get into these fancy annuities that try to index it to a market and they're expensive. But I would talk to a flat fee advisor who can look at your entire situation and give you the pros and cons. Because there's going to be questions about when, how much of your investments do you annuitize, the exact terms of the annuity, is it inflation adjusted, and all these different things that you're going to want to work through. So that's what I would do. But I think it's worth considering. Paul asks, is there a better bond fund than VBTLX for a 3-fund portfolio? Perhaps VBLLX. I don't know. Did I say that out loud? So this is just the total bond market index fund. I think it's the same thing as BND, the ETF version. If it is, it's an intermediate term. Yep. So there it is, 6.79 effective duration, and yeah, it's got kind of a little bit of everything. The one thing it doesn't have are tips. Well, it doesn't have munis either, or not really. And then, so that is sort of the standard, fund to use if you're going to use Vanguard for 3-fund. VBLLX, is this just long-term? So the risk with long-term is that interest rates are so low that if they go up, this fund is going to get hammered. And you can see by how much by looking at the duration. Come on, Morningstar, you can do it. Here we go. So remember the other one was like 6.5, 6, 7. This is 15.6. So if rates go up by 1%, this fund drops by 15.6% roughly. So that's something to keep in mind. So I personally wouldn't put my money in a long-term bond fund. Or if I did, I would just have to, talk about diamond hands. I ain't ever selling. The alternative to the intermediate term bond fund we looked at, one approach, and this would be the David Swenson approach, would be like a treasury fund short term, maybe intermediate. Put half of your bond fund. So this would become a four. This approach would make it a 4-fund portfolio. You put half of your bond allocation in like a short term or long or intermediate term treasury fund, and the other half in tips, a tips fund. Tips protects you in case inflation is higher than we think it will be. The treasuries protect you if inflation is not higher than we think it's going to be. And that's why David Swenson sort of recommended it, because you kind of cover yourself. The other approach would be just treasuries, short term, maybe intermediate term. I think those are all reasonable. I like Swenson's approach. The problem with tips is that they're negative yields right now, and I just find it hard to put my money in something that yields a negative return. Okay, how are we doing on time? It's almost 1. I'll go for 15 more minutes. Thanks for hanging in there. You guys are amazing. Well, here's a good question from Salty. Does it really make much difference to defer Social Security withdrawal to later, after 66 plus, rather than say 63? So here's where I think it's worth spending a few $100 to get a Social Security expert. This is particularly true if you're married, to figure out the best strategy to take, because there's a number of different strategies, and it can take a lot of research to figure it out on your own, and it doesn't cost much. I can tell you in our case, at least for me, I mean, my wife may end up taking it earlier, but for me, it just makes sense to wait until I'm 70. But every situation is unique. In our case, it has to do with the money we already have and wanting to use Social Security as kind of a longevity insurance policy, a longevity insurance, so to speak, meaning the risk that I live, to be 145 or whatever. God help me if I do. But if I did live that long, I'd get to see the Ohio State Buckeyes win a lot of championships. So it can make a difference. Yeah, it can make a big difference. But every situation is different. Rodolfo says, what is your opinion using Chartmill? I have no idea what Chartmill is. Again, I'm going to take this off the screen for just a second. Never heard of Chartmill. It's a stock screener. Oh. There it is. I don't know, but it looks cool. Well, you've done it now. Rodolfo, you've now burned my afternoon, because I'm sure I'll be looking at that website. Yeah, I don't know. I'll check it out. I'm not a big stock screener guy. If I want to find stocks, I'm reading people. I'm basically reading about value investors. And I'm reading a great book now. A great book, whose title I forget. Richer, something, wealthier, happier. It's a really good book, and it's about value investors. I had Guy Spear on my podcast a while back. He's fantastic. He runs a hedge fund out of, I think he's in Switzerland, maybe. But I study value investors and what they invest in. I want to invest in something just because someone else does. But I get a lot of ideas from that source. I don't use a lot of stock screeners, but I'll check this out. It could be great. Samil asks or says, when interest rates rise, the price of bonds drop, right? But I want to know if the dividend payment rises or not. And he says, I'm talking about BND or BLV. We know BND, that's the intermediate term sort of bond fund. We just looked at the mutual fund version. So I guess I don't quite follow the question, because dividends would come not from these funds, right, but from stocks or stock fund. Dividends. So the actual amount of the dividend rises or falls depending on how well the companies are doing in the economy. In sort of normal or good markets, they tend to go up each year. In bad markets, think 08, they go down. I'm talking about the actual dollar amounts, right? If you owned an S&P 500 or even a dividend fund. The yields change every day, right? Because it's a function not just of the amount of the dividend per share, but also the price. But I may not be answering your question, so let me know. Scotty says, you mentioned that Dave Ramsey likes American funds. Are index funds just as good after paying the higher expenses and loads that American funds charge? I think so. And I think they're probably better. Here's the interesting thing. There was one American fund. Let me see if I can find it. Again, let me pull this off. It's the American Fund, the Growth Fund of America, I think, is sort of one of their flagship funds, AGTHX. Let me pull this up, AGTHX. Let me show you what I'm doing. See if I've got this right. AGTHX. Yeah. And if we put 100% into that, and we compare it to VU, now this is only going to go back to 1985 at most. It probably won't go back that far. Yeah, just 2011. I need to change out VU. Let me put SPY goes back farther, I think. How far does it go back? Yeah, 94. So American funds have crushed the S&P 500. Now, this accounts for expense ratios. It does not account for sales charges. So the front end load, for example, it does not account for that. So you got to keep that in mind. And American funds, I believe it's this fund they sort of point to as, you know, we've beaten the S&P 500. And it's been a great fund. There's no doubt about it. You know, the question though, and I've changed this so that we're adding a monthly contribution because that can change the results, although I'm sure it's still outperformed. Yeah, by quite a lot actually. So it's done extremely well. AGTHX, I think you have to buy this through an advisor, and it's got a load usually. Well, they've taken that off. Why have they taken that off the front screen? Anyway, 64 basis points. I know this has a load in most cases. There could be some exceptions if it's available in a 401k. Of course, one of the reasons it's done extremely well over at least a big part of that time period is because it's high growth. I wonder how it compares to like a VUG. Let's put VUG in there. Of course, it's just done as well more recently. So VUG actually beats the American funds, but this only goes back, it goes back to 2005. So part of its outperformance is because of growth, which is important. Again, you want to know, when you look at this, you need to try to do your best to figure out why. Again, you might not be able to figure out why. But when you look at VUG, this Vanguard Growth ETF, it's done even better than both of them. And so it raises the question, you know, is it going to do better going forward? And that's one of the reasons I got out of actively managed funds, is because they can outperform for a while. It's rare for them to outperform for 20, 30, 40 years. And even if they did, they're going to have some years where they underperform, and am I going to be able to stick with the fund? That's always a big question. So that, by the way, is just one American fund. They've not all performed that well. So I don't know how much that answers your question, but there's no doubt that that fund has done well. So Robert says, I've started using New Retirement, which I mentioned earlier, a great tool that I use. I'm still learning it, frankly. He also uses MaxFi Planner, which I don't know if I've seen that before. MaxFi Planner. Here it is. I think I have seen this, but I've never used it, so I'll have to check that out. He says it helps with the Roth conversion modeling. So New Retirement does offer a Roth conversion tool. Maybe MaxFi does as well. I'll have to check that out. I'll check it out and let you know what I think. All right, what else we got? So Big No says, when should they sell their S&P 500 ETF? They're 60 and retiring. Well, are you talking about selling it for next year's income that you need to live on? Are you going to sell it entirely? I don't know. Those will be the questions. Like, what's your plan for your asset allocation once you're in retirement? We actually touched on that a little bit in yesterday's video, just briefly, really. I still think the starting point is 50 to 75% in equities, and for all kinds of reasons, it could then change depending on your circumstances. But Kenny says, do you think Social Security will ever be means tested? It wouldn't surprise me. It wouldn't surprise me. There are good reasons not to do that, but financially, I don't know how we keep doing what we're doing. So. Yeah, Dan mentions Right Capital, which I don't know if it was Dan that emailed me about Right Capital or someone else. But you have to, I think, work through an advisor to get access to it. In that sense, it's kind of like eMoney Advisor. But there it is. I'll start putting links to some of these things below each video. By the way, below this video, once I'm done the live stream, and all my other videos, I have a link to my newsletter that goes out every Sunday morning. If you sign up, make sure you add my email, to your contacts or whitelist or whatever, because if not, it'll go to spam. When I test the email, which I do every Sunday to make sure it's working correctly, it goes to my own email, goes to my spam folder. And the reason is because, you talk about money in there and investing and financial freedom, and those are sort of trigger words for spammers. All right. Here's an interesting question. Jonathan, he goes, I got a question from my dad. He didn't like my answer. It's usually the other way around, but okay. Usually my son doesn't like my answers. Anyway, why not just invest in all the stocks that VTI invests in, VTI, Total Stock Market Index, versus actually investing in VTI? My response was that I don't feel like going through the more than 3,000 stocks and clicking buy. Is there a better response? Well, what he's proposing actually exists, Jonathan. It's called direct indexing. And it's exactly what he's described. I don't know if they do it for VTI. They do it for the S&P 500. And there are some advantages to it. You can get more tax loss harvesting opportunities because the S&P 500 as a whole may be up, but there may be 50 or 100 stocks in the S&P 500 that are actually down. And maybe you could sell those and harvest the losses. But you're right. Who wants to click buy on 3,000 or 500 stocks? But you don't have to. Wealthfront, a robo-advisor, offers direct indexing. And they don't always use all 500. They can say, look, we don't need to use all 500. We can mirror the S&P 500 with 50 stocks, 500 stocks. We can get very close, high correlation. And in fact, I've got a video plan for this. I keep saying that. I do. I have like a ton of videos that I want to put together. Vanguard is going to start offering direct indexing. I don't know what that's going to look like, but yeah. So it is a thing, Jonathan. Just Google direct indexing. Mark wants to know, Rob, what are some safe investments other than bonds? Well, if by safe you mean not volatile. CDs, money markets, savings accounts. I don't know if I'd call those investments. But it's hard to think of other things that are less volatile than, say, and by bonds, I assume you mean a short-term bond. People will often go to other investments that have high yields, REITs, master limited partnerships, preferred stocks. And those are options, but I'm not sure they're less volatile. Preferred stocks are one area that I frankly don't know a lot about. I know what they are, but in terms of sort of understanding the risks associated with them as compared to a bond, I'll have to do some more work on that. Okay, I think I answered the question on the equal weight indexes. I just don't feel a need to do that. And I'm not confident they'll outperform over the long term. AGTHX, is that the one I looked at? Yeah, okay. That question from Don. Yeah, it's a good fund, Don. Again, it's been good in part because it's highly concentrated in growth. Growth has been on a tear. Some say that we're going to rotate into value. I think we will when interest rates start to rise. We just don't know when that is. But if growth is what you're after, there are better growth funds, right? We looked at VUG, and it outperformed. I wonder, too, let's go to our friend, the QQQ, take out the S&P, put in QQQ. Did it outperform? Boy, it crushed them all, right? So like, I guess my point is, if you really want growth, I'm not sure American funds is that particular fund, is necessarily the way to go. But I get scared going into that kind of growth just because of where we are. And I think at some point interest rates have got to go up, I think. Like I said, I've been predicting that since 2010. Great question from Salty. With stocks, how much weight do you give to analyst price targets? Nada, zero. Stupid Smee says, I'm meeting with an Edward Jones advisor for the first time in an hour. Overall, are financial advisors a good or bad idea? I think financial advisors in and of themselves, if you've got good ones, could be a great idea. The problem are fees. And that's why I think a flat fee advisor is better than someone that wants to charge you a percentage of assets under management. Sherry says it's easiest to predict backwards. It is, and we even get that one wrong a lot of times. It's funny, I'm reading through biographies of all the presidents. I'm only on Madison, so I'm just getting started. And we're in that phase where they finally passed. They finally got a constitution, which was of course a big brouhaha. And Virginia almost didn't ratify it. Patrick Henry was a real pain in the butt. So was Monroe, actually. He was not a fan, or George Mason. In any event, you got Madison on one side. He's at this point a representative, right? And Hamilton, who's Secretary of the Treasury, right? This is during the Washington administration. And they're dealing with money and money supply and borrowing and debt. And it's fun to read that. It's like, yeah, the things we're dealing with, we've been dealing with them for a long time. And Madison's trying to figure out what causes inflation. Because there was all these different competing currencies. And different states wanted to have their own currency. And Madison's like, no, we don't want to do that. There was inflation, and what causes inflation? Is it the money supply? Fascinating stuff. All right. I think we're getting near the end. I'm just looking at the last few comments. You guys have been great. I will be back next Thursday at 11 a.m. Eastern Time. Between now and then, I'll have some other videos. Some of them might be live streamed, but this is the only one where I do Q&A. JMac77. I'll finish with this one. He says, as a Wolverine fan, I have to unsubscribe, sadly. I have no choice. I'm glad to hear that, because had you not unsubscribed, I'm afraid I would have had to have banned you from the channel. So appreciate you taking that burden off of me. And with that, I will simply say, OH! And until next time, next week, have a great day. Until then, remember, the best thing money can buy, apart from tickets to an Ohio State Michigan game, is financial freedom.